Well, it was a five-star week for stocks last week as the S&P 500 notched a 53rd record high of the year on Friday. Well, it was goals galore for fixed income bulls as treasuries rallied hard across the curve, though the dollar faced some penalties, snapping an 8-week winning run against a basket of peers. There's now two major market focuses on the horizon as December gets underway, with the renewed threat of Trump trade tariffs looming ever larger and Friday's US labour market report on the horizon as well. Plenty for myself and Ryan Littlestone to discuss on the trade-off. So without further ado, let's crack on with the show. So it is, of course, the start of December. We're into the last few weeks of 2024. And joining me, as always, to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. And, I apologise on your behalf for the state of your outfit today, Ryan. I assume you're still commiserating yourself over the dismal West Ham performance at the weekend by celebrating that pretend European trophy you won a couple of years back.
Yes, well, for the viewers who may not be aware, I lost to Michael's team 5-2 this weekend, hence why he had those comments in his opening remarks, mentioning the 5, mentioning the 2. It didn't go amiss. And, yeah, I sat down and he launched into a song about the score. So I took my shirt off and stuck this on because I knew he was going to have a dig. But, my little trophy here. Just want to remind the viewers, I think the last time Arsenal won a trophy, Mr. Trump was president, I believe. So maybe you'll get lucky this time around.
Oh, there we go. You never know. Although it's not looking too likely this season. Anyway, speaking of Trump, there is plenty for us to get into, not just in terms of what Trump's been saying or tweeting or truthing, I suppose you could call it now, but also with everything else that's been going on and is likely to happen this week. So let's get into Topical Thunder. Right, before we get on to what the Orange Man has been saying, let's have a look at this week's main data event, which is, of course, the US labour market report due up on Friday. It is, of course, the last jobs day of 2024, and we're set to round out the year with a relatively strong labour market report, with the November NFP print seen at plus 200,000. And, of course, that compares to the relatively dismal 12,000 jobs that were added to the US economy in October. Now, of course, a big chunk of the jobs gain that we're likely to see in the November data is really an unwind of those temporary factors that depressed the October figure. And that was, of course, hurricanes Helene and Milton, which made landfall shortly before and during the survey week, and also the strike-related weakness at Boeing and the other companies in the Boeing production chain. So non-farm payrolls seem rising by 200,000. Of course, the forecast range is as wide as ever, between 155 and 270,000. In terms of other metrics that we'll be looking at, unemployment, that's seen holding steady at 4.1%. Now, it's worth noting that those who are temporarily unable to work are classified differently in the establishment and in the household survey. And that's why we didn't see unemployment rise substantially in the October print, and why we're expecting that to hold steady this time around. Participation, that should be there or thereabouts. The cycle high is at 62.7%. And earnings, they're seen rising by 0.3% on the month and by 3.9% on the year. Although I would say that the risks to that data is probably skewed a little bit to the downside, given that the temporary job losses we were just talking about, they disproportionately hit those on lower incomes, skewing the October figure higher. And if we see that unwound, you'd expect it to skew the November figure lower. Now, obviously, the jobs report is one of, if not the key factor ahead of the next FOMC meeting coming up on the 18th of December. When I looked this morning, the market pricing about a 2 in 3 chance of a 25 basis point cut. But I'd argue that things are a little bit more clear than that, and that it would actually have to be a ridiculously hot labour market report to deter Powell and co from another 3 weeks' time. I think what the market pricing is more reflective of is what I will call the Trump risk and the tariffs and the reflation inflationary agenda that's likely to come early next year. But of course, the Fed cannot and will not be able to account for that until the back end of January, when those policies are enacted. So I think the jobs report, in many ways, it could be an interesting one, not for its macro implications, but because of the potential market move, because obviously now we're past Thanksgiving, things are likely to be pretty thin in terms of liquidity and trading volumes at this time of year.
Yeah, I think so too, and it's going to be a wonky one whichever way, because if we do get, some of that October washout coming back into the market, then in theory it should be a strong number. But this is the NFP; it's a lottery at the best of times. If it comes in a weak one, I dread to think how the market's going to deal with that one. As far as the Fed's concerned, I think the market is beginning to get a little bit too dovish over the Fed. You've got people calling for a pause and reducing rate cuts into next year. The Fed aren't in a rush. Their objective is to get rates down to a neutral level, have the economy bubbling along nicely, keep it nice and calm. Good luck with that. And, as much as they've tried previously, but that's the aim anyway. So they're going to continue with cuts, and if they can go slow, they'll go slow, but they're going to get there eventually. But this data, it's always going to be big. It's the biggest data point a month. That's why we love it. And that's why Michael leaves it to the last minute to put his guess in.
Yes, indeed, midday on Friday, as always. Check my Twitter feed. Right, well, I've got to say, Raf, our stand-in producer, he's clearly getting ideas above his station. Look, he's moved the slides on already. He's telling us to hurry up, I think.
Oh, it's nice to have a producer in control of things these days and keep you on your toes anyway. We love Kyriakos, but yeah, someone needs to take you to task. Right, anyway, central banks is what we're talking about, and I'm talking about the end of the cut phase, which Michael nicely gave a little spoiler on Twitter this morning. It's not calling for the end of the rate cut phase, but we have to remember that when we trade a rate cut cycle, a big part of the market is always looking ahead to the future, so past the end of such cycles, and not just what the central bank is doing here and now. So yes, at the moment we have that constant pendulum swinging over the size of any hike or cut going into any particular meeting, that just like we mentioned with the Fed, are they going to hold, are they going to go to 25? But we are also trading what comes next. And at this stage of the cut cycle, we have perhaps had the first glimpses of the market starting to think about, the end of rate cuts. The RBNZ is a good case in point. Last week, the price moves since then have maybe given us a bit of a little trigger into that. They went a 50 basis point cut. They forewarned of another 50 basis points in February. Then they also indicated that their neutral rate, terminal level, whatever you want to call it, is around 2.5% to 3.5%. So with rates now at 4.25%, that gives them only 75 pips more of cuts just to get them to their top limit of that range. So if they go 50 basis points in February, that leaves them only a 25 pip cut to get to that top end. So that alone insinuates they might start slowing down to 25s. If they do want to continue to the lower end of that range, then they might be looking to take that in slower steps, so 25s from there on out. Now, long story short, they will be coming to the end of their cut phase. Since the RBNZ meeting, the Kiwi dollar particularly has been on a much firmer footing versus the dollar and versus the Aussie dollar as well. And that's even while there's still a widening rate divergence with the RBA. Now, that's the clue that the market knows where the RBNZ is going and how long until they're effectively done. So unless something develops that causes them to become even more dovish, the market is starting to go into that what next mode, what happens after banks get to their terminal level. So it's important to know this when trading and that this market shift takes place and when it takes place, because that can change trends and it can also change how assets have been performing previously, because they've been trading a certain way based on these cuts. If those cuts stop, what happens next?
No, I think that's a very good point. I think we may be a little bit premature in discussing, the end of rate cuts, but you are right. The discussion is starting to turn to what comes next. I think certainly in the Eurozone, we're hearing an increasing volume of ECB speakers now starting to talk about whether they need to go below neutral. I know Isabel Schnabel, one of the most influential members on the exec board, had a speech out last week saying that actually she thinks get to neutral on weight, whereas obviously there's other members Villeroy, Centeno, etc., who are saying they do need to move into loose territory. And I think the ECB, along with the Swiss National Bank, are probably going to be the first of the first two of the G10 central banks to get there. Just a word on the RBA. I mean, is there anyone who's made more of an absolute pig's ear of this economic cycle? Their communications way back when interest rate hikes started were terrible. I think Philip Lowe, the governor at the time, was saying that rates would be held steady for 3 years. So if that was right, they still wouldn't have even hiked by now. And now the labour market's turning, inflation is back in the middle of their target band, and you've got the governor, who's now, of course, Michelle Bullock, saying, no, there's no need to cut rates for another few months. I mean, what are they doing?
Oh, exactly that. And I remember his comments because we had it on the show. He said that the earliest the RBA would cut will be 2024. And here they are in 2024. They still got rates ridiculously high, and like you say, not even close to cutting at the moment. So yeah, there's going to be different speeds. I think, as I mentioned before on the show, the ECB, I think they're going to be the one that get forced to cut further than they expect. I wouldn't be surprised if they're taking rates under 2% to go, towards the middle or latter part of next year, if the fundamentals are still as they are now, because they're going to have to get into a position where they're going to be chasing the economy low and trying to boost, stimulise the economy rather than just, getting rates back to a normal level.
Yes, no, you're absolutely right. Well, let's have a chat about Europe then, shall we? There's a bit of a sort of rule of thumb, and I'm sure you'll subscribe to this view, Ryan, that when we start talking about spreads in the Eurozone, it's never a particularly good sign. And what I mean by spreads, of course, is generally the difference between a 10-year yield, whether it be in France, Spain, Italy, Greece, and that of the 10-year Bund, which is considered the safest government debt in Europe, although, of course, Germany have their own litany of issues to be dealing with at the moment. In any case, attention is now on France, because France are having an absolutely woeful time of things trying to pass a budget. Of course, Michel Barnier, their prime minister now, trying to get through a combination of spending cuts and tax hikes, which comes to about 60 billion euros. And this is, of course, as the budget deficit is on track to balloon to about 6% of GDP. Now, the EU have a sort of an ostensible limit of 3% of GDP for a budget deficit, so we're talking about double that. Of course, this is annoying pretty much everyone in France, and you have Marine Le Pen threatening to bring down the government over the affair, the National Rally being the largest party in the French legislature. And as a result, you've seen the OAT Bund spread hit its widest level since 2012 at about 87 basis points was the wides that we hit towards the back end of last week. Now, this is just another factor to add on to what is a very, very, very long list of bearish euro catalysts that are out there. We alluded a second ago to what's going on in Germany. Of course, we've got snap elections coming up on the 23rd of February next year, so not particularly snappy, but they are earlier than we were expecting nonetheless. The Chinese economy is in the doldrums. There's no sign of any recovery there. And more worryingly, there's no sign of any further stimulus. The Chinese government trying to prop up the market rather than trying to prop up the real economy. The Eurozone economy is in what can only really be described as a manufacturing depression at this moment in time, and the services sector is heading pretty rapidly south if you look at the latest PMI surveys. Geopolitical events aren't helping, and of course now you've got the threat of tariffs from President Trump as well. We had news of tariffs on Canada, on Mexico, and on China last week. Well, he didn't mention the US's fourth biggest trading partner, which is, of course, Europe, so you would expect them to be in his sights relatively soon. But I would argue, and I'm keen to get your views on this, Ryan, I know we were having this parity or 110 debate last week, but I would argue that we're probably not far from a point where a lot of this bad news is actually in the price, and we reach what you would call peak pessimism for the euro, whereby no matter how much more we add to this laundry list, the impact on the market is comparatively limited.
I'm going to take the other side of that a little bit. Yes, the bricks, the negative bricks are building up in this wall, but I'm wondering if it's going to come to the point where the market says enough's enough and, really starts getting out of Eurozone assets, European assets, different countries, because obviously the euro dollar is the biggest currency in the world. So it's got a lot of support from commerce, from whichever way you want to look at it. But when you get so much news, negative news, it's only so long the market can ignore that before it turns around and says, you know what, we're coming into the new year. Yeah, we may have made some money out the Eurozone, but if we want to put our money to real work, where are we going to put it? Are we going to put it in a faltering Eurozone for another year? Or perhaps are we going to put it into the US, where you've got Trump resurgent and looking to, take the US economy to new heights or whatever. So I think while it may be that you're seeing it priced in at the moment, I think that might be a bit of a false sense of security. And when we get into the new year and we get those funds and investors reallocating their money, deciding where they want to put it, I think the euro's going to be in trouble.
Well, we shall see. Anyway, speaking of Trump, you seem very excited about this one, judging by the number of exclamation marks that are going on here.
Yeah, I'm a little bit excited about this one because we have been waiting for it to happen. And even last week, Shah said it might be a bit quiet until he gets in the hot seat, but he didn't even wait until this has been published, I don't think, before he started tweeting and whatever. But like him or loathe him, if you are trading, you need to be plugged into the new president. In his first spell as president, he and his team moved markets via social media, an awful lot. And while he's been fairly quiet, as I say, since the election, he came back with a bang last week. And as Michael said, that news on the tariffs on Mexico, Canada and China, and that was just over immigration and drugs and trafficking and the whole shebang. But he came out on Twitter and we saw all three currencies. Sorry, he came out on his Truth Social platform and all three currencies weakened significantly. But the big news was that he dropped that news on his social media platform, and it took at least a minute for that to hit the main news wires and then for the market to move. So in trading, that's an absolute lifetime. And, if you were plugged into his platform, you would have had plenty of time to react, maybe trade the headline or get out of a trade or whatever. Now, even if you're not a headline trader, that's okay, but you still need to be plugged in, because if you're in a position that could be negatively hit by one of his truth bombs, or you may be able to save a loss if that happens. Of course, if you're on the right side of the trade, then you may get an opportunity to take some quick profits faster than you might have expected. But the real importance here is that for the next 4 years, you have to take how Trump does things and factor them into your trading. You're not going to catch every tweet or every headline, but if you know it's a risk, you can be more prepared for it. So without making it an advert, get yourself on his old platform and get your alerts up to speed.
Have you got some sort of affiliate program going on there? Are you getting, I don't know, what would Trump give away? Maybe like a fake tan for every subscriber he gets or something? Is that where this is going?
No, if I can get an affiliate deal, I'll try and get one. But
no. I'm sure you would.
And it's free to join. They're not going to pay me much, but yeah.
Well, that's true. No, but it does raise a very good point. I mean, I can't and won't repeat the exact language that I used when I woke up at 4:30 on Friday morning to see that we're, back on the sort of tariff tweet Truth Social merry-go-round that we had from 2016 to 2020. But it does raise a very good point. I think moving into 2025, of course, and once Trump has been inaugurated, this is going to become the theme. We're going to be dealing with markets that probably move a lot quicker and with arguably structurally higher levels of vol as well, as we deal with these sort of unexpected events and developments and headlines. And, as you say, it is probably arguably a more even playing field than we would typically see, when a news wire like Bloomberg or Reuters picks up a story and then it takes some time for it to be disseminated out to the sort of general public. If something's posted on a social media network, then everyone sees it at the same time, and also everyone is trying to react to it at the same time, which can make things very, very choppy. The one thing I would say, just lastly on this, a sort of broader point, I do wonder whether Trump has, maybe lost some of the shock factor. You look at particularly the announcement of tariffs on Canada. Everyone went, oh, that's quite significant. Dollar CAD spiked to a 4-year high. Everyone then took a step back and went, well, hang on a minute, it's Canada. The US and Canada are super close. Trudeau's already on his way to Florida to go and have a chat with him. And the market move paired very, very quickly indeed. So I do just wonder a little bit whether markets have sort of think they've found Trump out and actually going, this is just a negotiating gambit rather than anything serious. But only time will tell.
Yeah, I think they're absolutely right. But then we're here to trade. So if you get a market move, and you're right, he hit that headline. Markets move, those currencies moves, and then we had his comments with Mexico's Scheinbaum saying that they're going to work things out, and the moves reversed. But that's what we want. We want price moves, and I want to know, have you got an account over there yet?
I haven't, but I was going to say, we can't always get what we want. You wanted a win in the football at the weekend and you didn't get it, but never mind. Right, let's crack on with some charts in That's a Setup. I would say I'm sorry, but I'm not.
But you won't. I know you won't.
So I won't bother. Instead, we'll talk about the dollar because we did, as I said earlier on, see the dollar index snap an 8-week winning run last week, with the greenback now back, well, towards the top end of this range that has been in place for the last couple of years. When you look at the dollar index between 99.5 and 107, 108 to the upside, I think it's a little bit difficult to read too much into the moves that we saw last week. It was effectively a 2.5-day week in the United States, and the rest of the week was dominated by very, very thin conditions around Thanksgiving, which probably meant that month-end flows had a little bit more of a substantial impact than you would usually see. In terms of the fundamentals, well, I think the macro case for the dollar has not changed at all, to be completely honest with you. The idea of US economic exceptionalism is still running strong. The reports that we've had as to Black Friday and Cyber Monday sales point towards a record holiday period, which is likely to underpin growth in Q4. And the FX market at large is still seeking to buy growth. So I struggle to do anything other than remain long the dollar at the moment, and would be looking to scoop up any dips. Although, given what we were saying earlier about the potential for peak pessimism in the euro, I do wonder whether we're starting to perhaps get towards a time where it's worth being a little bit more selective where we are long dollar, rather than just looking at something like the dollar index. You look at, for example, cable. I see absolutely nothing at all to like when it comes to the UK economy, and we heard this morning that business sentiment is at its worst level since the very start of the pandemic, whereas you look at something like the euro and you actually say that most of that bad news may well be priced in. So while I remain bullish on the buck, I think just want to bear in mind that perhaps, probably one for the new year, a little bit more selective than we have been this year, where the gains have been relatively broad-based.
Yeah, I think that's a key comment as well, being selective, because what we've seen over the last couple of days, Thursday, Friday, into today, obviously low liquidity periods, US holidays, end of month, that sort of thing, is different dollars moving in different ways. Here we had this morning, we had cable rallying, we had dollar yen rallying, euro dollar going the other way, and that messes around with the Dixie index, because obviously it's the higher basket is euro dollar. I think taking the dollar alone, that bottom that we got on Friday and coming into this week was pretty much based on what we saw in yields. And last week I was speaking about 10-year yields. We need to be careful as it approached 4.20%. We dipped under that just late on Friday, 4.18 I think we got down to. And we opened up this morning above it at 4.20, 4.21, and we're holding above it for now. So I think that's marrying in with what you're seeing in the Dixie, the dollar generally at the moment, just those yields holding in 10 years. If that 4.20 goes, then I think this is heading a lot lower.
Are you seriously doing technical analysis on 10-year yields?
No, I do it on the price, but you watch the levels. I said 4.50 was a level, knocked it on the head. I said 4.20 was a level, and we bounced from it.
Oh, we're getting close to Elliott Wave / astrology territory here. Let's move on, shall we, to the euro?
Yes, let's.
You're a fan of Europe, clearly, judging by the show.
Yes, I like winning in Europe. There's a difference, Michael.
There is not a lot of winning in Europe going on at the minute.
No, very much so. And for the euro dollar, we're still deciding what we're going to be doing at this 105 level. I spoke about the euro dollar last week and this 105 level, and after that blowout move to the 103s, we're still not moving far away from that level. The downtrend from 112 is still firmly entrenched, and that confirmation move that we got on Friday, where we rose up to 106 and held it, was a key move in keeping that downtrend going. That 106.0011 area is a decent level all on its own, and we've contained bounces there several times. And so I still favour the downside for the euro, and if this European data keeps going the way it is, keeps disappointing, as I said earlier, I think the ECB is going to be forced to cut rates further than they think or they would like. And as I said, that's going to be a big factor going into 2025. But from here, if we do keep holding this 105 level and even moves down to 104.5, then there's a possibility of seeing a bit more of a bounce than we've seen so far. That might take us up through that 106 level. But I think moves like that will be fleeting and find plenty of sellers coming in. I'm already short this one up near that 106 area. And I'll be happy to add to that in small pieces on in decent rallies. Only a move really over something like 108.70 would make me question being short, but that would also depend on why we're moving up there. We're in the last month of the year. Year-end moves can get a bit funky as positions get closed off and profits get booked for year-end reports. So I'm going to be watching carefully how this moves. If I see a move that's happening because of year-end factors rather than what's going on in the fundamentals, then I'm going to stick to my short bias for that.
Yeah, my view hasn't really changed particularly much. I always find it relatively difficult to work out what's going on over Thanksgiving. And, I think this is a perfect example of that, to be completely honest with you. So, if you're interested in our views on the euro, go and watch last week's show, I guess.
Oh, we could have said that at the start. It would have saved me doing this section altogether.
Well, it would have done actually, but we'd like to put you through your paces, mate. Just to you don't want to get rusty or anything like that, do you? And no, speaking of things that can't rust, let's have a look at gold, because the yellow. Sorry, that was even by my standards, that was terrible. I'm not going to lie. Yeah. I think that's worthwhile.
And that's waiting. That's waiting. Don't worry.
Well, they definitely won't go rusty, the amount they're used. Right. Anyway, gold, it remains relatively interesting. The yellow metal having failed to break back above $2,700 an ounce, and also having failed to break back above the 50-day moving average, despite a couple of attempts last week. So you would actually argue that despite the fact that we've had 3 or 4 consecutive daily advances, the sellers are still in control here. Price fundamentally remains a little bit trapped between the 50-day moving average to the upside at 26.70 and the 100-day moving average to the downside, which is about 25.70. So a decent $100 or so $100 an ounce range for the day traders to play in and have their fun. But I think the bias remains towards further downside. And if we were to get a closing break below $2,600 an ounce, then that is likely to invite further sellers to come into the market. A broader point that I did want to make, and this applies to gold, but also really any asset that has had a strong run, particularly a strong bullish run this year, is as we come towards the back end of the year, something worth thinking about is where is the fresh money going to come from? Gold is up by about 30% year to date, and we've got 3 weeks of the year to go. Arguably, the bias, therefore, is probably more tilted towards people taking profit as they close up their books and as they square off their positions, as opposed to anyone trying to come in and chase this rally in the last 3 weeks of the year. So I think that's an important consideration for things like gold and anything else that has enjoyed a particularly strong bullish trend this year, with the yellow metal up by 30% since December.
Yeah, I think we might be setting up for a bit of range playing going on between that November low and the November high. So I can see a bit of sideways action coming. I did want to ask you a couple of questions on this one, because we've had this, I don't know if it's a story or non-story, about this China deposit of gold that they found over there. It's $83 billion worth or something, the biggest gold discovery ever or something. It hasn't been, as far as I can see, floated around in some of the major press. I think we first got it from the Daily Mail last week. So I'm wondering if we've seen a bit of reaction to that. Also, we had this news over the weekend, Zelensky speaking to Kyoto press about how looking at diplomatic channels to maybe gain back their occupied territory rather than keep fighting for it. So there's one risk headline that might have impacted gold this morning, but what do you make of this other story?
Well, my honest reaction is that's the first time the Daily Mail has ever been mentioned on the trade-off, and hopefully it's the last as well. It is, of course, important, but I would be a little bit skeptical. I don't think supply influences precious metals as much as it does something like crude. Let's put it that way.
Yeah, I mean, the only reason I bring it up is because China have been one of the biggest buyers of gold. Hence, they caused pretty much the majority of this rally. And they did stop, buying 4 months ago now? Yes. So could this discovery be behind it? Means that's one big buyer out of the market. I don't know, but I think it's something to keep an eye on.
Yeah, definitely worth keeping on the radar. Well, anyway, that's a nice segue. Speaking of China.
Yes, that's what I'm going to look at next. And I'm wondering whether the dollar-China exchange rate is going to be hitting their real intervention zone. We've had another tariff threat from Trump to China. That's got the yuan weakening further. So far, we've had tariffs threats on trade. We had last week's drugs tariff threat, and now we've got the BRICS currency tariff threat that he threw around this weekend. So dollar-China has now hit levels that we've not seen since earlier this year, around the 728. 730 area, and that's close to the 2023 highs up near 737. The high back then was enough of a move for Chinese authorities to fight back against yen weakness and start drawing some real big red lines. We know that they can step in and get their banks to sell dollars in small parts. That's merely to slow the move rather than put a block on it, but that was a level where they did draw a big fat red line, and we came down from that. Now, I've been eyeing this area that we're seeing now, 728, 730s, and those prior highs up to the 737s for trying some shorts, and we're up here again, and already the PBOC have been applying the brakes via their fixes. They've been keeping those fairly low, so that makes me think about maybe getting in and starting some shorts up. But not all situations are the same as they were in the past. And as we're up here, even before Trump has taken office, there's a big risk that the yuan might weaken even more. However, I'm happy to maybe make this trade just as much about the technical picture as the fundamental one. So I know where my risk levels are. Above 737, something's going on, and I probably won't be sticking around too long. I'm also going to keep my trade sizes reflective of that risk. I'm going to keep them fairly small. So it's okay to fight against the trends as long as you know when you're wrong and that your trade risk reflects the fight you want to pick. And that's what I'm looking at in this pair.
Yes, I mean, I think this is certainly one to watch. What I would say is
that's your second, you're off. Get raffled.
Thrown off the own show. What I would say with the CNH or the CNY, whichever way around you want to look at things, always be cautious, because the government can and do move things wherever they want to, exactly as you have just outlined. The other thing I would just say in passing, you mentioned this BRICS nonsense around, are they going to trade with something other than the dollar? Are they going to come up with their own currency? The usual sort of line on this one continues to apply. The dollar is not dying. The dollar is not going anywhere. I highly doubt that anything will replace the dollar as the global reserve currency in either of our lifetimes, to be completely honest with you. So this does feel a little bit like a storm in a teacup. But again, it comes back to what we were saying earlier about the increased volatility and uncertainty that Trump is going to bring with these musings on the internet.
Yeah, absolutely. And I was actually discussing this earlier today, whether Trump's using the tariff stick a bit too much and the market might become a bit numb to it over the months ahead, because, there's only so many things you can throw a tariff threat at before countries start to call you bluff. But they seems to be working for now.
No, that's very true. And it could end up just becoming a bit sort of boy who cried wolf, where, tariff threat, leader rings him up, tariff threat disappears. Well, very quickly, the market's going to get wise to that game. Right, let's move on to our plays of the day. Right, I am looking at crude this week. Same old story, I guess, really. What we've seen for the last 6 months or so, crude rallies on geopolitical risk, and then the market comes in and fades that move. And that's exactly what we saw last week, with WTI down by about 4 or 5% on the week, trading as low as $68 a barrel, and again, failing to sustain a move north of the 50-day moving average. On the supply side, we also had OPEC kind of giving into the inevitable. They've delayed their meeting until this Thursday, but they're likely to delay their scheduled output hikes as well. But to be completely honest with you, I struggle to see that making especially much difference, certainly when the demand side of things remains pretty dismal. The manufacturing PMIs that we've had to kick off the new trading week have not been exceptional. And of course, we have the ISM data out of the United States due in about 20 minutes after the time of our recording. And then, of course, you've got Trump nominating Scott Bessent as his Treasury Secretary and saying that he wants to produce 3 million barrels per day in additional US production. Well, OPEC are talking about 5% of that in terms of their output hike. So I don't think we're really tinkering around the edges with that one. Fundamentally, then, you're looking at higher supply and lower demand, and that is likely to exert pressure in only one direction. Now, of course, short positions in crude, still not something I'd be looking to hold over the weekend, but if we do get a break below this 67.25, 67.75 region, then that is a break I would be looking to sell into. Ryan, we are looking at the euro again.
Yeah, looking at euro sterling this week and the potential for a big level break. And we might be on the cusp of a significant breakdown in euro sterling. Now we're under the 83 handle. That's as we record this anyway. We do have a bit of a safety net around 82.76, and that's been a tested level for many, many years, but one we've not been able to hold below for very long. So I'm going to be looking at shorts in this one if we fail a retest of the 83 figure, or we get and hold below this 82.76 level. Such a move could mean we're heading to at least down to the 50% retracement of the big 2015, 2020 swing. That's down in the low 82s. This idea will really become invalid if we do move back above 8,300 and then see it holding a support once again.
Good stuff. Well, with that, we come to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, despite the rather dodgy outfit that he's been wearing. Thank you also to Raf for stepping in. Kyriakos will be back next week, but I don't think we need him. We've got a better, younger model helping us out now, so Raf can hang around. In any case, hopefully you have enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets and your thoughts on anything that we've discussed, and we'll be back with another episode of The Trade-Off this time next week. In the meantime, thanks as always for watching, and goodbye for now.